Recently, Jim Chanos has disclosed that his hedge fund, Kynikos Associates, is still maximum short on Tesla, and that it is still, quote, one of his favorite short positions. Today, I'll take a look at the bear case of Tesla. I examined the extreme bull case a few weeks ago with Cathie Wood, so now I'll take a look at the other side, so stay tuned. Hi everybody, welcome back to The Contrarian. My name's Logan. I really like to talk about overall success, investing, and most of all going against crowd thinking mentality. So if you like these kinds of topics, just consider subscribing. Also, I want to make a disclaimer that none of this is to be taken as financial advice. To begin with, I know that I'm going to get a lot of disapproval for even looking into the potential for Tesla to go bankrupt. And I want to make it clear that I was at one point actually a Tesla bull. I thought it was a good investment a few years ago. However, I recently sold out. I just personally think it is overvalued right now. But I think that with any company, it is important to look into both the best and worst outcomes and investigate the likelihood of either occurring. Unfortunately, this will always be biased since we have preconceived notions, but let's just try to set aside preconceived ideas about Tesla or Elon Musk. First of all, let's look at Jim Chanos. Jim Chanos is a very reputable short seller and probably has been the most successful short seller over long-term periods. His hedge fund, Kynikos Associates, has returned an average return on investment of 22% over the last 35 years, which is double the S&P 500. This is really big because short selling is much more difficult than going long in that you don't have unlimited time. Your options will expire worthless, and you can lose a lot of money doing it. So it says a lot that he's been able to get those kinds of returns consistently for 35 years now. Also, he has historically performed very well in bear markets, obviously, while the rest of the market suffers. So he kind of dreads and does poorly during bull market periods. For example, very few of his most recent predictions have yet to play out. The most notable of these being Tesla and his bear case on Tesla. He's definitely underperformed the stock market in the last 5 years. However, considering the big picture, this still doesn't hurt his record much. Recently, he cashed out of a Wirecard short that paid him $100 million, as well as Hertz and Luckin Coffee. He shorted those. So, I mean, he's really been doing quite well so far this year in 2020, while the markets as a whole have been very uncertain. And basically all of these still could happen. You know, Tesla is still up in the air. It's not a done deal, to say the least. So let's look into what his argument is about Tesla and the bear case for Tesla. Now, I honestly doubt that this is his favorite short position, as he says, as he has lost a lot of money on it as the stock has continued to climb. But nevertheless, he still maintains that he has a winner and that the mob chasing Tesla is delusional. In his most recent interview, which was back in April, so that's even before Tesla went parabolic recently, he insists that Tesla is extremely overvalued. And like kind of like Warren Buffett, he is often a man of few words and hard to read. But let's take a look at the things he was saying back in that interview. Basically, the only reason he gives here is because of manic investors jumping on board hoping for a further boost, and that this mirrors a lot of the insanity we saw around the dot-com bubble burst. Now, we might tend to poo-poo this and say that this has little to do with the stock, but I'll bring up something that conflicts with this. Just a couple of days ago, Tesla did a 5-to-1 stock split, as I'm sure you're aware of. So its stock was around $2,000. It became around $400 a share, and its share count was multiplied by 5. Now, just because of this factor alone, not because of any fundamentals or production numbers or anything that Tesla was releasing, not even because of their battery day, Tesla's stock rose by more than 10% in that day, closing in at all new all-time highs and giving it a market cap of over $440 billion. So I think there's a lot here to what Chanos is saying. Kind of like what I talked about with index funds distorting prices in the stock market, and how index funds effectively take away price discovery, which is what the stock market is all about. This simple move of a stock split gave Tesla the necessary optimism and new buyers to go up 10% in one trading day. This sort of a move, especially for such a large company, is pretty rare. And it really shows that there are a lot of investors in Tesla who are not investors, but are speculators. They're seeing this parabolic run-up in a stock and seeing all of the tweets from Elon and his fanboy base, and they want to jump in. Now, in my opinion, if you don't have $2,000 to spend on a share of Tesla, you should not be investing in the stock market at all. But Tesla's stock split made it to where people who had, say, only 500 in their Robinhood account can use it to buy a share of Tesla. These are not the kind of people who are long-term investors. They will get out at the slightest need for cash, or if they see another more popular stock. So this is a very risky position for Tesla to be in. Should the stock market as a whole correct again, and it will, Tesla could fall like a rock. I've talked about David Hunter and how he's predicting an 80% drop for the S&P 500 during 2021. And if the S&P 500 does something like this, what will Tesla do? Fall 95%? I mean, what'll it do? Back in March, the S&P 500 fell roughly 35%, and Tesla fell from 950 to 350. So this is a fall of over 60%, so almost double what the markets did. When the markets do crash again and investors pull money out of index funds and stocks, what are they going to pull it out of? I would think a more speculative investment like Tesla would have much more outflow than a generally considered safe company like, Costco, Coca-Cola, Clorox, any of these more safe companies. And we're beginning to see this from some of Tesla's largest investors. Billy Gifford recently decreased its position from 6.3% to under 5% of Tesla. Now, I wouldn't be surprised if even Elon was thinking of selling some of his Tesla shares right now, or at least soon. If he thought it was an overvalued stock back at 700, he would definitely think it's overvalued around 2,500. And all this is ignoring the major macro factors that could sink Tesla as well. We have already seen flatlining demand for their cars for the last 2.5 years. And this is including all of 2018 and 2019. And 2019 was a knockout year economically, yet Tesla's growth was nowhere near the exponential growth that is being claimed by the fan base behind them. So it's not even a growth company anymore. What happens if trade tensions increase? Or the economy crashes as many are predicting? People won't be buying new cars, much less expensive and hard to repair cars. Tesla's customer base is not the average person, it's the upper middle class, but mostly the wealthy. In economic crashes, these people are going to lose the most money. They're the people who own the most assets, which are going to decrease in value. So needless to say, I just think, as I've said before, that Tesla is a very, very risky investment right now. And, it could be a ticking time bomb. Again, this isn't to be taken as advice, but just my thoughts about Jim Chanos and the bear case for Tesla. Now, I don't know if I would short Tesla, as like a famous investor has said, the market can remain irrational longer than you can remain solvent. So, even if it's a good short, I just don't know when this would play out. But let me know what you guys think. Is Tesla the next Enron equivalent? Would it go bankrupt if the economy collapsed? Would someone buy them out? Would an Apple, would a Google buy them out? What do you guys think of Jim Chanos' argument here? Anyway, let me know what you guys think, and I hope to see you again.